Over the years, many people have labeled Warren Buffett a relic of the past, outdated past his prime and irrelevant. You've probably heard this sentiment echoed countless times, especially during bull markets when newer, flashier investors were dominating headlines. But in times of crisis, like the 2025 market collapse we're currently witnessing, it's precisely Buffett's disciplined, patient approach that starts to shine. Let's set the record straight. This so-called dinosaur, the man who built his wealth through the 50s, 60s, and 70s, has made an astounding $11.5 billion in stock market gains this year. Meanwhile, many of the major players, the one who are touted as the modern-day financial geniuses, are watching their portfolio shrink. So before we dismiss Buffett as someone who lost his edge, we should probably take a closer look. And more importantly, we should be able to learn from him. But let's be clear, just because we can learn from his approach doesn't mean we should try to copy it exactly. Buffett's financial situation is unique, and he plays in a different league. Consider the Bloomberg Billionaire Index among the top 20 richest individuals. Only 2 have gained money so far this year: Warren Buffett and Francois Bettencourt. Everyone else, they're deep in the red. Jeff Bezos lost $43 billion, Larry Ellison is down $45 billion, Larry Page is short $35 billion, even Steve Ballmer, once considered unshakable, is down $20 billion. And Jensen Huang, he's taken a $28 billion hit. Michael Dell, $35 billion. These aren't minor corrections, they're massive drops. Let's rewind a bit. There was a time not too long ago when investors and media personalities were comparing Cathie Wood's ARK Invest to Buffett's portfolio. They'd say things like, she's crushing him, or Buffett doesn't understand today's market. That kind of talk always pops up in bull markets. The minute people start calling Buffett and Charlie Munger has-beens, you can expect an overheated market. But here's the twist. While the flashy names were grabbing headlines, Buffett was prepping. He wasn't aggressively buying stocks. In fact, he wasn't even buying much of his own company stock. He was playing defense and selling. That's a signal. Buffett has openly said, often nothing looks compelling. That's not laziness, that's wisdom. What he means is that the market in his view has become so overpriced that the risk of investing isn't worth it. So instead of gambling, he's waiting. He's waiting for the market to correct and to offer him quality businesses at discounts. He's waiting for filet mignon to sell at hamburger prices, and when it does, he'll be ready. But don't confuse waiting with inaction. In fact, last year alone, Buffett sold $143 billion worth of stock and only $9 billion. That's the net sale of $134 billion, the largest in Berkshire Hathaway's history. That's not a small shuffle of a portfolio, that's a strategic retreat. And where'd all that money go? To cash. Buffett is now sitting on a massive $341 billion pile of cash. That's more than half the value of Berkshire's entire stock portfolio. He's not just sitting on that cash either. He's parked it in short-term treasuries earning 4% annually. That translates to about $13 billion in passive income just from interest. Again, this isn't fear, this is discipline. Buffett is saying, I'll wait and I'll be patient. So what can we learn from this? First and foremost, don't mistake market noise for market wisdom. We live in a world where investment success is too often measured by short-term price movements. As stock goes up and people call it a good investment, and stock falls and they call it a failure. But that's not investing, that's speculation. Buffett's long-term investors understand him. The value of any investment is rooted in its future cash flows, discounted back to today. That's the foundation of real investing. It's as fundamental as gravity. And while you can't change the future cash flows of a company like Microsoft, those are driven by the company itself. You can control how much you pay for it. That's why price you pay determines the return you earn. And when the market is euphoric, people forget this. They stop calculating returns based on fundamentals and start focusing on recent performance. And that's how bubbles form. But the problem with chasing price action is that it disconnects you from actual value. And that's why Buffett doesn't just chase performance, he waits for margins of safety. He looks for situations where even if the leadership at a company makes mistakes, the business is strong enough that it will provide reasonable returns. And that's the heart of what he calls principle-driven investing. If you want to apply these principles to your own investing, start by embracing what's called dollar cost averaging. Yeah, sometimes you'll overpay, but you're doing it with a plan. The plan isn't based on timing the market, but on consistently building wealth. Over time, your average cost will reflect the market's average value, and you'll avoid the common pitfalls of emotional investing. Here's a simple but powerful mental image. Think of the market's intrinsic value as a steadily rising line. Meanwhile, the market price zigzags above and below it. When you dollar cost average, you're buying both at highs and lows, and this helps you capture the true long-term growth of the market. And when the market falls, when everyone else panics, you'll be the one saying, if I was willing to buy up here, why wouldn't I buy down here? But let's say you're interested in picking up individual stocks with some extra money. If that's the case, then you need to be even more disciplined. You have to live by a few key principles. Number 1, you are an investor, not a speculator. Number 2, every investment is the present value of all of its future cash flows. The more you pay, the lower your return. Number 3, if you don't understand a company, don't invest in it. Buffett himself has admitted he doesn't understand tech for a long time, not because he thought it was bad, but because he couldn't confidently project its future cash flow. It then changed over time, especially as companies like Apple evolved. But he was never going to buy Apple in 2000 when it looked like a sinking ship. He waited until he understood it. Number 4. In the short term, the stock market is a voting machine. People buy what's popular. But in the long run, it's a weighing machine. Fundamentals always win. So if a company's financials are improving but the stock is falling, that's not necessarily a red flag. It might be an opportunity. But to take advantage of that, you need mental toughness. The media will follow the stock price, not the fundamentals. And lastly, number 5, a great story can be a bad investment if you pay the wrong price. Just because a company is exciting, innovative, or beloved doesn't mean it's good to buy at any price. When the masses love something, they often overpay. When they hate it, they might be undervaluing it. These 5 principles guide every investment we make. Before we pay any company, we must ask ourselves 3 questions. First, do we believe this company will be around 10, 20, or 30 years from now? If the answer is yes, we can then move to the second question. Do we believe the company will be making more revenue, profit, and cash flow in that future than it is today? If that's also a yes, then we ask the third and final question. Can we buy it today at a price that makes sense given the cash flow it will produce? If the answer is yes again, then we consider investing. Don't misunderstand us. We are not Warren Buffett. We're not nearly as wealthy as he is. But we do live with a level of financial freedom that allows us to invest without desperation. That means we don't have to take wild risks. We can be patient and we can be thoughtful. And you can do the same. Do everything at your own risk. Whether you're dollar cost averaging into index funds or picking individual stocks, remember, the stomach, not the brain, is what true investing happens. You'll always have the knowledge in the world, but if you can't stomach a downturn, you'll sell at the worst possible time. That's why dollar cost averaging is a powerful strategy and one that we recommend. It helps you stick to a plan, and if you want to dive deeper into it, we put together a great free guide you can download to understand how to implement it properly. So what's Buffett doing with all that cash? He's not just sitting on it, he's sending a message. He's preparing. And if you look back on history, every time Buffett builds up this kind of war chest, it's because he sees something coming. Today's market feels eerily familiar to him, and to many others who have been through multiple cycles, such as what we're seeing now. He's not yelling, but he is sounding the alarm. And if you've been paying attention, you'll recognize that now is the time to prepare, not panic. The markets will always test your emotions. It will lure you in with stories and shake you out with fear. But those who succeed are the ones who stick with principles, the ones who stay patient, the ones who wait for filet mignon at hamburger prices, and then will be ready to pounce when that moment finally arrives.